7 levels of investing, how the game changes at every stage. Level 1. The beginner, you open your investment account for the first time. The screen looks simple: buy, sell, numbers moving up and down. But none of it feels simple. You deposit your first $500. Not a large amount, but enough that it matters to you. You scroll through stocks companies you have seen your entire life. You are not just buying a price. You are buying a small piece of something real. That idea takes time to understand. You make your first investment not to trade it, to hold it. Slowly you start paying attention differently. Not just to prices, but to what the company actually does, how it makes money, why people buy from it. You read articles, different opinions. Some focus on short-term moves, others talk about long-term value, and you begin to notice the difference. Some people are trying to predict the next move. Others are trying to understand the business. That becomes your first real decision. What kind of participant do you want to be? At this level, your returns are small. That is fine. What matters is learning how the system works, how markets behave over time, what ownership actually means. And once you begin to understand that, something shifts. You stop watching every movement. You start thinking long-term. And that is when you move to the next level. You are no longer just learning. You are participating. Level 2. The retail investor, you invest every month. Not when the market feels good. Not when prices are rising. Every month, $500, $1,000, whatever your budget allows. You set up automatic contributions into your account. From there, you allocate your money index funds, ETFs. A few individual stocks you have researched. Your portfolio starts to take shape. Not randomly by allocation. 60% equities, 20% ETFs, 20% cash. You begin to understand what diversification actually means. Not just owning multiple stocks, owning assets that behave differently under the same conditions. The market drops. Your portfolio drops with it 10%, sometimes more. This is the first real test. You do not sell because you understand something now. Volatility is not risk. Selling at the wrong time is. You keep investing every single month. This is called dollar cost averaging. You are not trying to time the market. You are building exposure to it. Returns are still relatively small, but your behavior is no longer random. It is structured. You think in years, not days. And once your portfolio reaches a size where every move starts to matter, your strategy has to evolve. You are no longer just participating. You are building something that compounds. Level 3. The consistent investor, your portfolio crosses $100,000. And that number changes how you pay attention. A 1% move is no longer abstract. It is $1,000. For the first time, returns feel real. You stop thinking only about how much you contribute. You start thinking about compounding. Your strategy becomes defined. You set a target allocation: 70% equities, 20% fixed income, 10% cash, and you stick to it. You rebalance based on percentages, not emotions. You start focusing on risk-adjusted returns. Not just how much you made, but how much risk you took to achieve it. Market corrections no longer feel like a crisis. They feel like part of the process. You begin optimizing taxes, holding assets long enough for long-term capital gains, using tax-advantaged accounts wherever possible. At this level, your behavior becomes consistent. You invest regularly, maintain your allocation, and follow your strategy regardless of short-term market movements. Success is no longer about picking the right stock. It is about executing the same disciplined approach over time. And once your portfolio grows large enough that small improvements begin to matter, your approach shifts again. From simply managing investments to actively optimizing them. Level 4. The advanced investor, your portfolio crosses $250,000 to $1 million. And your focus shifts from building wealth to optimizing how it grows. At this level, small percentage improvements begin to make a noticeable difference. A 2% increase in returns is not minor. It can mean an additional $5,000 to $20,000 per year. You move beyond basic asset allocation. Equities still drive growth, but you start adding real estate, fixed income, and alternative assets alongside them. Tax efficiency becomes more important than ever. High turnover investments go into tax-advantaged accounts. Long-term assets stay in taxable accounts to minimize capital gains. You begin using tax loss harvesting to offset gains. You evaluate investments based on expected return versus downside risk. The question is no longer how much can I make? The question is, what is the probability of loss, and how large could it be? Diversification becomes intentional. At this level, investing is no longer about individual decisions. It is about building a system that performs across different environments, because as your capital grows, avoiding major losses becomes just as important as generating returns. And once your capital reaches a point where access itself begins to change, the opportunities available to you change as well. Level 5. The high net worth investor. Your investable assets cross $1 million. And that changes how the financial system treats you. You are no longer limited to public markets. New opportunities begin to appear not because the investments themselves changed, but because your capital now qualifies you to access them. You start participating in private investments, private equity funds, venture capital deals, real estate syndications. These are not traded on public exchanges. They are introduced through networks, advisors, and financial institutions. The structure is different. These investments require larger minimums, longer holding periods, and reduced liquidity. Your capital may be committed for 5 to 10 years. In exchange, the potential returns can be higher, but so is the risk. You begin working with professionals, private bankers, financial advisors, tax specialists, not to replace your decision-making, to structure your portfolio more efficiently. Your portfolio becomes more complex. Public equities remain important, but they are no longer your only source of returns. At this level, the challenge is no longer accessible. It is selection. Because once your capital reaches this scale, opportunities do not need to be found. They are presented. And as your capital continues to grow, investing stops being something you do occasionally. It becomes your primary focus. Level 6. The professional investor. Your capital crosses into the $10 million to $100 million range. And investing is no longer something you do on the side. It becomes your primary function. Your portfolio is large enough that performance matters in absolute terms. A 5% return is no longer just a percentage. It represents $500,000 to $5 million in annual gains or losses. Every decision carries weight. You manage your investments actively, not through frequent trading. Through structured decision-making, you evaluate every opportunity based on expected return, downside risk, liquidity, and time horizon. Your portfolio is diversified across multiple asset classes: public equities for growth, private equity for long-term upside, real estate for income and appreciation, fixed income for stability. You may begin running capital in a formal structure, a family office, or investment entity. Performance becomes measurable. You compare returns against benchmarks. Consistency matters more than individual wins. Large drawdowns are harder to recover from at this scale. Your identity shifts. You are no longer just an individual investor. You operate like a portfolio manager, and as your capital continues to grow, your decisions begin to extend beyond your own portfolio. They start to influence where money flows. Level 7. The institutional investor. Your capital moves beyond personal scale. You are now allocating hundreds of millions to billions of dollars through a fund, a family office, or an institutional structure. At this level, you are not just managing money. You are directing where large amounts of capital are deployed. You no longer focus on individual securities. You focus on allocation decisions. How much capital goes into equities? How much into private markets? How much into credit, real estate, or alternative strategies? You invest through managers as much as you invest directly. Hedge funds, private equity firms, venture capital funds. You evaluate them based on track record, strategy, and alignment of incentives. Due diligence becomes critical. A single allocation can involve tens or hundreds of millions. Liquidity becomes a strategic consideration. You cannot move capital quickly without affecting pricing or access. Decisions are planned over quarters, sometimes years. Your capital begins to influence outcomes. Large allocations can support companies, sectors, or entire strategies. When you commit, others follow. You are part of a network. Information flows through relationships. At this level, investing is no longer about selecting assets. It is about directing capital at scale. Because once capital reaches this size, it does not just participate in markets, it begins to shape them. And beyond this point, the